Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
All right, let's just dive right in. So Good Inc., ticker SOWG, presents what I think is one of the most intellectually, challenging paradoxes we've seen in small cap restructuring for a while. We have a company that just months ago delivered a total operational collapse. A Q3 2025 financial disaster that should have, by all traditional metrics, led to a swift liquidation. And yet the stock is still trading near 50 cents. And the recent volume spikes show clear speculative interest. This is all driven entirely by the sudden corporate shift on December 31st, 2025, with the appointment of David Lazar as CEO and that injection of $6 million in capital. It is a textbook bifurcated situation, absolutely, and we have to determine which path really defines the entity now. The central question for any investor has to be this.
In light of that unquestionable operational failure that just wiped out the entire underlying business, does the residual value of the NASDAQ shell and the track record of its new management provide a justifiable speculative floor, what some are calling the Lazar put? Does that decouple SOWG from its negligible fundamental value?
Absolutely. I argue that SOWG is no longer a CPG company. It's a financial instrument. It's a restructuring play. The historical financials are, for all intents and purposes, sunk costs, and the equity's value now resides in its structural mechanics and the, frankly, highly predictable strategy of its new leadership. We should be analyzing this as an event-driven trade, not as a food business.
And I hold the contrary view. I believe the sheer scale of the operational catastrophe, compounded by a series of truly, egregious governance decisions made during the transition, creates a level of liability and distrust that just overwhelms any short-term technical play. For any investor who is seeking intrinsic or even, let's say, responsible speculative value, this entity remains fundamentally uninvestable. The past is not irrelevant. It defines the governance DNA that we are buying into right now. Okay, so let's establish the foundation for my position, which is the structural value thesis. We have to accept that SOWG has completed what I would call a structural metamorphosis. The operational metrics are now just history. Who cares about the negative 576% gross margin from Q3 2025? That failure was the painful but I think necessary cost of achieving the current state, a NASDAQ-listed shell.
Okay, hold on.
You can't just wave away a negative 576% gross margin and call it irrelevant history. For anyone listening who isn't steeped in these microcap financials, that means for every dollar they tried to generate in revenue, they were losing almost $6 just on the cost of goods sold. That wasn't just a poor quarter. That was a systemic failure of their entire production and supply chain model. That is a permanent stain.
Symbol. The value now resides entirely in the NASDAQ shell itself, which, even in a distressed market, typically commands between, $2 million and $5 million. So SOWG's current market cap is supported by this structural floor alone, particularly when you view it through the lens of the new CEO's strategy.
And that brings us to the Lazar playbook. You frame it as a reliable, standardized model. I need you to unpack that, because I see that playbook failing to account for the unique level of strategic liability this particular shell brings with it.
Well, the playbook is simple, it's well-defined, and it's historically reliable. David Lazar, through his involvement with entities like Titan Pharmaceuticals, Kala Bio, Nova Bay Pharmaceuticals, he follows a standard procedure. First, you inject stabilizing capital. SOWG got $6 million to keep the lights on and maintain compliance. Second, you assume leadership. Third, you immediately reposition the entity for a reverse merger, bringing in a robust private company that wants a quick public listing. It's a mechanism for monetizing his own preferred stock investment, and the market reacts predictably to this. When you took over Kala Bio, the stock surged 28% pre-market purely on the anticipation of this strategic pivot. This playbook provides a speculative floor.
I understand the theory of the playbook, I do, but I'm sorry, I just don't buy that SOWG fits the mold perfectly. We have to address the underlying catastrophe.
The Q3 failure wasn't just poor management. It was strategic blindness that led to an $8.5 million non-cash inventory charge. And that wasn't a write-down of old product. That was inventory lost due to catastrophic thermal control failures during transport. They allowed inventory to build without verifying the integrity of their most critical supply chain step. But the most damning element for me is the governance failure that concluded the Goldfarb era. We are talking about a very questionable take-under scenario. They sold the core revenue-generating assets, the candy business, which pulled in $16.1 million in 2024 revenue, to a related party, Tria Grove LLC, for a nominal $1.5 million. Just think about that. They sold a business that generated $16 million in revenue for less than 10% of that figure. This transaction socializes the operational loss onto public shareholders while allowing the insiders, through a related party, to privatize the potential brand turnaround. It's a governance betrayal that should make any fundamental investor just run the other way.
I see why you feel that way about the Tria Grove transaction. I do. Focusing on the governance optics, it looks bad. But let me give you a different, maybe more pragmatic perspective. If SOW is structurally dead as a CPG company, then the operational past is a sunk cost. The divestiture, however controversial, represents the cleanest possible break. A clean break for who, exactly?
A clean break for the corporate entity that remains. The company has essentially cleared the deck of broken operating assets and, crucially, offloaded the associated disposal costs and immediate liabilities. So if we accept the premise that we are now investing in the listed corporate infrastructure and not the freeze-dried candy technology, then selling the mess, even messily, was a necessary step to stabilize the balance sheet and preserve that NASDAQ compliant status. The shell is now streamlined for its next purpose.
That narrative requires us to ignore the lasting stain of strategic blindness and, frankly, corporate negligence. Let's contrast SOWG with its peer, Branch Out Food, BOF. They operate in a similar high-growth specialty food niche. While SOWG was reporting a horrific negative 576% gross margin, BOF was executing flawlessly. They were reporting 93% growth and 39% gross margins in the same period. SOWG's failure was not market-wide. It was unique and it was internal. The Tria Grove transaction, far from stabilizing the shell, it confirms the most cynical view. It proves that the insiders successfully retained the value of the brand potential, the real long-term asset, while leaving minority shareholders holding the bag with the liabilities and the empty shell. For those shareholders who bought in on the promise of the brand, this was the ultimate transfer of wealth. And it's a definitive signal that the value of that operational potential is gone forever.
That's a compelling argument regarding governance, I'll grant you. But the market is forward-looking. The market, specifically the technical trader base, is focused on the predictability of the Lazar playbook. So the question isn't whether the previous management was negligent. The question is whether the current management can successfully monetize the shell he inherited.
And that's exactly where the unique liabilities of SOWG come into play, potentially derailing that predictability. I mean, SOWG faced a critical liquidity crisis pre-Lazar. They only had $387,000 in cash remaining. This shell comes with significant unresolved legacy liabilities that may not have plagued his previous targets. It's not a clean SPAC or a clean slate failure.
But the liquidity issue was solved at least temporarily by the $6 million injection. That's what's sustaining the 50-cent trading price right now.
It's not entirely solved, though, and I'm not convinced by that line of reasoning, because the terms of that funding are critical. The remaining $4.2 million of his facility is explicitly contingent on stockholder approval for necessary corporate actions, like potentially increasing authorized shares or other compliance measures. If the residual resentment from that Tria Grove deal, that governance betrayal, leads stockholders to reject the necessary actions, the company remains profoundly vulnerable.
Vulnerable to what?
Vulnerable to the bleed-out scenario, what you'd call Scenario C, where it just lingers, it fails to merge, it's forced into a reverse split to maintain NASDAQ compliance, and it loses all relevance. Or even worse, Scenario B, liquidation. This shell comes with an approval hurdle that his previous, perhaps cleaner shells might not have faced. Lazar is incentivized, yes, but that incentive is tied to shareholder goodwill that may not exist anymore.
The very volatility and risk you're describing are precisely what fuels the speculative opportunity. We have to pivot to the microstructure here.
The threat of liquidation or severe reverse split keeps the short sellers betting aggressively on the downside, but the technical reality of the float creates extreme tension.
Tell me about the float mechanics. They are definitely the engine driving the volatility.
Well, when you account for the high insider holdings, about 41.2%, and the institutional holdings, the effective tradable float is small. We're talking roughly 4.5 million shares. And how many shares are currently sold short? We're looking at about 453,000 shares. That means the concentrated short interest represents roughly 10% of the effective tradable float. That's highly significant.
10% of the float is indeed significant. I grant you that. It creates operational risk for those short sellers.
Exactly. So if Lazar successfully navigates the approval hurdles and announces a merger target, scenario A, the Lazar squeeze dynamic is highly probable. The short sellers who have piled in based on the negligible fundamentals will be forced to cover into an extremely tight, illiquid float. Retail speculators, who I call the lotto players, are actively positioning for this, and they've replaced the disillusioned fundamentalists. This technical reality justifies a high-risk hold or trade rating for speculative capital. The volatility potential is the remaining asset.
That's an interesting point, and I acknowledge the viability of the short squeeze as a temporary trading opportunity. I would, however, frame it differently. The squeeze is a purely temporary technical mechanism. It relies on the illiquidity of the float, and, it often lasts only a few hours or days. The inevitable structural and long-term result of scenario A, the reverse merger, is massive, systemic dilution, often 90% or more, to the existing shares. This dilution is absolutely necessary to compensate the owners of the incoming private merger target.
And the market knows this, so the risk is priced in to some extent.
But the consequence isn't always fully understood by the lotto players driving that spike. Even if the stock spikes temporarily on the announcement, say from 50 cents to $1.50, the subsequent post-merger dilution effectively transfers nearly all of the original shareholder wealth to the new controlling entity. So fundamental investors must absolutely avoid this transfer of value, regardless of the temporary technical spike. The long-term ceiling for current shareholders is catastrophically capped by this dilution risk. You might win the squeeze lottery, sure, but you lose the investment game.
You were right that the long-term fundamental outcome is dilution and a transfer of equity value. That is the price paid for restructuring and recapitalization. But my entire thesis rests on the fact that SOWG is no longer valued by traditional metrics like revenue or gross margin. It is a derivative of corporate restructuring, and therefore volatility is a value. The combination of a financially motivated, specialized CEO like Lazar, the tangible value of the NASDAQ listing, and the tight float mechanics provides a structural setup that separates SOWG from a simple fundamental liquidation. It is an instrument designed to be traded purely on news catalysts and technical structure, not held based on enterprise value.
And I conclude by just emphasizing the unavoidable risk. While structural mechanics may indeed create temporary trading opportunities for sophisticated event-driven speculators, the underlying reality is a total operational failure, a highly dubious related party asset transfer that confirmed insider self-dealing, and the near certainty of severe future dilution. For any investor seeking intrinsic value, the governance track record and the dilution risk make the company a definitive avoid. It trades solely on the hope of a short-lived technical spike designed to serve the new entity and its principals, not the legacy shareholder base. So we are left then with the understanding that analyzing SOG requires viewing the company through two entirely different, non-overlapping lenses, that of complex financial engineering and that of traditional CPG operations and governance.
Precisely. The data provides definitive evidence for both views.
The Q3 financials confirm the catastrophe, while the 8K filings on Lazar structure and the microstructural data confirm the opportunity for extreme technical volatility. It highlights the critical difference between speculating on technical dynamics and investing in fundamental recovery. There is certainly more to explore in how these speculative dynamics impact market efficiency, especially when governance failure is so profound.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.